So this week we have seen restrictions ramped up by the government because of the increase in the spike of the coronavirus. And off the back of the announcement from the two scientific advisors, we've then had Boris Johnson give us the lowdown and what these new restrictions are and how long they're going to be in play for. Then we had the chancellor who announced his next stage in his plan to keep jobs going and keep the economy in survival mode. So in this video, we're going to talk about what that means for property. Hey, what's up guys? Dan Trevidi here. I hope you're all well. So in this video, we're going to talk about what is next for property. If you were like me, you were probably glued to the TV when the Chancellor gave his announcement and you were watching it and listening with a lot of interest. And I've got to be honest with you, I thought the extension to loans being repaid was a really good thing. So that does mean that effectively the cash flow has improved for nearly every business that's taken them out who wishes to extend to pay those bounce back loans back. And if you haven't already taken one out because you're thinking, do I need one? Am I going to be really affected? My advice has always been to take one now because you just do not know what is going to happen in the future. Did we think that when the lockdown started to ease and things like Eat Out to Help Out came in, that we would be going into a second spike so quickly? The answer, I think, is probably not. And the reality is we could easily go back into a second lockdown. So your business is going to be in a better position if you had that fund sat there. And even if you did nothing with it, it's there as a safety net and it's better in your pocket short term before you have to repay it back, before you start accruing interest. So if you haven't already, take out that bounce back loan. Now, as you know, my view on the property market is that we have already been through the height of the drop, if that makes sense. We have already been in the worst position when the housing market was frozen, and the deals right then, based on the attitude and behaviour of most of the people, was that it was the time to buy. And I did pick up lots of deals, some excellent ones, some of the best deals I've seen for like 10 years. They were coming at me left, right and centre. And even now, I had a property that was pre-lockdown already agreed, and then in lockdown we renegotiated and exchanged, but we delayed the completion because the person selling needed to do that for their own circumstances. And this week I completed on that property, and that's 20% below market value pre-lockdown, but it's probably closer to 25% below market value based on the boom of the current prices. Now that doesn't really matter because I'm going to refurbish it and turn it into like a 5-bedroom student house with 5 en suites and hold that long term because that is probably going to be the closest property I have to the university. So overall, a great deal. I'm going to be able to extract a lot of the cash out that I put in and have a really good cash flowing property. And that's not because of what's going on in the market today. That's because I knew when to strike. And yes, there's a lot of negative comments about, was I right, was I wrong? Well, the proof in the pudding is in the eating. And I can only tell you what I've paid for properties versus what they were before lockdown and versus what they are today. But that's not what you're watching this video for. You're watching this video to get my take on what is next for the property market. Now, I have said on a couple of other videos, and I am out there on my own, no one else has said this, but I'd like to think that most of my predictions and lots of my guesses have come to fruition. They've been pretty spot on. And I said in the previous video that yes, the market is booming, and there is a lot of different factors to that. One of the main reasons is that the market was completely frozen. So after you have a period of freeze, you always get a mass rush for people to start doing and carry on what they were doing. And that's why we saw such a massive boom. I think it was like up 13% in August just on its own. So that is all pretty much due to the appetite of buyers and sellers. But there's obviously things that are artificially inflating the market, and things like stamp duty, holidays is one of those things. And there are some other bits and pieces also playing in the market. Now, I know everyone's view is that in March, when the stamp duty holiday comes to an end, everyone believes the housing market is going to fall off the edge of a cliff. And my prediction in one of my previous videos was that there is no way the Chancellor is going to allow a complete stop to that scheme. There will either be an extension, a phased out, or a new scheme phased in to compensate for that market recovering over a sustainable period, not recovering and then dropping completely as of like the 1st of April. And the furlough scheme ending in October, which isn't going to be extended, but this new job protection scheme is going to replace it. And I'll give you my view on that scheme in just a second, but that is a really good example on how our chancellor thinks. He knows that he can't just bring it to an abrupt end. So he needs to bring in something which is more sustainable for the economy, but also helps to protect jobs. And that is why he has brought that in. And I think that he would do exactly the same for property if we continue to see the boom that we are seeing. So watch this space. Now, this new scheme, which is basically people who are working about a third of their current hours can still be paid by the employer, and then the government supposedly will top up the rest. That's not actually what the detail says. What the detail says is that the employer will pay the third of the hours that are being worked, and then the other third is then split 3 ways. A third to the employee, they have to write off that money, a third by the government, and then a third by the employer. Now, I'm a little bit skeptical. Now, I am an employer, I have a trade and business, and I don't actually think this scheme is going to do much for my type of business and in my sector and my sort of size, because if you have staff that need to reduce their hours, or you need to reduce their hours because of the downturn in trading, then you need to do that, and you still need to pay them, and they still have a job. The bonus for the employee is that they don't see a significant drop in their wage if the employer is prepared to pay a third of that. And one of the biggest issues for businesses is that they are having to reduce hours because turnover is down, because there is a lot less demand in consumers buying and eating and drinking their products. So my view is, are businesses going to be rushing to do this? Are they going to be rushing to pay effectively 22%, I think it works out, of the total salary for the hours worked for the employee, just so they can have a little bit of a top up in their wage? Because 22% is a lot when you scale it up across tens, if not hundreds of employees. Why would the employer not just say to the employee, look, work a little bit extra and I'll cover your wage, but you're going to have to do less hours? That way the employer is getting the full return for his money, paying that full hourly rate, and the person is keeping that job. So I'm not a big fan of this. I don't think that it's going to be as well received as people are perceiving it to be. I may be wrong. But what does that then mean for the property market? So it is inevitable that there is going to be a downturn in people renting and people buying who are in these jobs, which are very, very vulnerable, and across these sectors. And this is anything from companies who are really struggling, who need to now start to make redundancies, for people who are furloughed. And this is also for people in sectors which are going to be massively hit by the restrictions of the social distancing, the group of 6, cutting of hours in the hospitality sector, all those various things. And that spillage effect will affect the market, but it's what parts of the market it's going to affect. And do I think it's going to have a significant effect overall on the market I play in? The answer is no. And do I think it's going to have a significant effect on the property market as a whole nationally? Again, I don't think it is. I may be wrong, but I just don't think the type of sector that is being affected, and then the wages which are being reduced and the job losses, is going to result in a significant decline in property purchases and sales. Now, the rental market, private sector rental market for HMOs or for single residential houses, this may well be affected, because lots of the people in these sorts of industries are typically the people who would rent a room in a HMO or would move from a rented house to another rented house. So it'd be interesting to see how this is affected in conjunction with the inability for landlords to start an eviction process relatively quickly. They can still do it, it's just going to take longer. So I think it's really worth watching and keeping one eye open on what the market does off the back of indirect effects. And this is going to be one of them. For me, I think at the moment, prices are sky high. I'm not looking to buy anything, but don't get me wrong, I will always buy something if I think the deal is good enough. Auctions are still the place to play. There is also some really horror stories of properties going way beyond market value because the retail investors get carried away with bidding at auction. So do be very wary of that. I'm a big believer in buying the worst property that no one else wants in the best area that can meet multiple markets. If you follow me on Instagram, you'll see I bought a commercial property at auction, which I underwrote, no one bid on it. I picked it up for 65,000. It was previously purchased by the vendor 10, 12 years ago for 125. So I picked up a really good bargain. And I have already rented that property for 10,000 a year. So the yield on the purchase price is absolutely fantastic. So the deals are still out there. I think it's time to take a little bit of a step back, get yourself into a position of strength, hold cash, refinance, get your properties tenanted, have your portfolio performing very, very well. I've been very surprised. I've got 2 commercial units, which I actually split from a title of residential, so I could get the residential part refinanced, thinking that my secondary market may struggle to find tenants in the current market. And this week, I have rented both properties to brand new businesses. So you can argue, is the covenant there? Is the risk to reward ratio there? However, to rent them in this market and to support a new business, I think is actually a win-win for both sides. So I'm really happy I've got it rented. I've taken a little bit of a hit on the rent. I've taken a little bit of a hit on the type of tenant and how strong the covenant is. But equally, I'm giving someone an opportunity. I'm giving someone a chance to create something that they want to in what they believe is a gap in the market in what is unprecedented times. So overall, I think it's a really great situation, and I will be bringing you a video on that project of some before and after pictures once it's all done, once it's all tenanted, so you can see that my previous video was 100% right in terms of the budget for the refurb and my projected rental income and the GDV that I've managed to achieve in the refinance. But look, that's it from me, guys. Really miserable weather outside, so I hope you're finding something to do inside. Hope you found the content rich, and I'll catch you all on the next video.